Right now, Navitas Semiconductor, ticker NVTS, is trading live at $7.97, up about 6 cents or 0.76% on the day. And right away, the immediate expectation versus reality disconnect with this stock is fascinating. Most people hear Navitas, and if they know it at all, they think fast chargers. They see a small, volatile semiconductor stock, maybe something they'd gamble on with the Robinhood app, and they lump it in with a dozen other small-cap tech names. The expectation is that this is a simple, one-product story. Gallium Nitride, or GaN, is replacing old silicon in the power adapter for your phone or laptop. It's a clean narrative, but that reality is incomplete and, frankly, it's outdated. The real story, what's happening under the surface of that $7.97 price point, is a far more complex and high-stakes strategic pivot. The company is in the middle of a massive transformation, moving from a GaN-only pure play into a diversified power semiconductor house. And that has fundamentally changed the risk, the reward, and the entire thesis for this investment. Let's establish the common ground because it is important. The market, by and large, has viewed Navitas as a high-growth disruptor. It's the kind of stock that attracts a specific kind of investor, often younger, tech-savvy, doing their self-investing on platforms like SoFi Invest or Robinhood. They see the clear benefit. GaN technology is faster, smaller, and more efficient than the legacy silicon that's been used for decades. The logic is simple. New tech beats old tech. This is the same narrative that fueled early bets on Tesla stock. The belief is that Navitas will just ride the wave of adoption in consumer electronics, then electric vehicles, and everyone who got in early will be rewarded. It's a story that's easy to understand and even easier to sell. It's the classic online investment growth story. But here is the challenge to that thinking, and it's the reality that the recent market action is forcing us to confront. That simple story is falling apart, not because GaN is failing, but because Navitas itself is telling us it's not enough. The company's recent earnings reports, its strategic announcements, and most importantly, its recent acquisitions paint a picture of a company facing immense pressure. The reality is that Navitas is now fighting a war on two fronts. It's not just GaN versus silicon, it's now GaN versus silicon carbide, another next-gen material. And Navitas, in a move that shocked many of the pure-play believers, has now jumped into the CIC market by acquiring other companies. This isn't a simple David versus Goliath story anymore. This is a complex strategic gambit. This isn't a stock for a passive Schwab Intelligent Portfolios account. This is a name that requires active monitoring, the kind of data you'd want on a professional interactive brokers trading platform. Let's look at the recent movement, because this is where the tension is most visible. That $7.97 price tag is the result of a brutal few weeks. Just a few days ago, the company announced a $100 million private placement. For those new to online investing, that means they're selling a large chunk of stock, in this case about 14.8 million shares at $6.75, to a select group of investors. The market hates this. Why? It's called dilution. It means your slice of the pie just got smaller. The stock plunged on the news. This was compounded by their third quarter 2025 earnings report on November 3rd. While they technically met some analyst guesses, the numbers themselves were alarming. Revenue plummeted over 53% year over year, a net loss of over $19 million. This isn't the growth story that SoFi active investing users were promised. But here's the disconnect again. Why raise $100 million if things are so bad? The company was blunt. It's funding the Navitas 2.0 strategy. This is the pivot. They're taking that capital and aggressively reallocating resources away from the low-power consumer market, like chargers, and sprinting toward high-power markets. We're talking AI data centers, industrial electrification, and energy infrastructure. This is a complete change in focus, and this is where that Nvidia stock narrative suddenly becomes relevant. The AI boom is creating a crisis in data centers. Power consumption. The processing needed for AI is astronomical, and the old silicon power management chips are inefficient and generate too much heat. Navitas is betting its new GaN and CIC solutions can solve this power problem for the AI industry. They even announced new GaN FETs specifically designed for NVIDIA's next-gen 800-volt AI factory platforms. So, the expectation was a simple consumer electronics story. The reality is a cash-burning, dilutive, high-stakes pivot to become a key supplier for the AI infrastructure boom. This changes everything. The trading volume we're seeing isn't just retail churn on the Robinhood stock trading app. The F13 filings, which show institutional ownership, are a massive activity. Recent data from NASDAQ shows that while Vanguard increased their positions, others like BlackRock and State Street have been trimming. You see hedge funds like Millennium and Renaissance Technologies taking new or larger stakes. This is a battleground stock. This is institutional money making big bets on that Navitas 2.0 story, while other institutions, perhaps those managing conservative Fidelity mutual funds, are getting out, spooked by the losses and the strategic confusion. When you're looking at investing sites or using your Fidelity mobile app, this is the kind of underlying institutional flow you need to be aware of. To understand the future, you have to understand the technology. For years, Navitas was Mr. GaN. Gallium nitride is a material that allows for much higher switching frequencies than silicon. In human terms, it wastes less energy as heat, so you can build a power supply that is tiny, light, and efficient. This was their GaNFast brand, and it was perfect for fast chargers. But the world is not that simple. For very high power, high voltage applications, like the main drivetrain in an electric vehicle, another material, silicon carbide, has been the preferred choice. It's more robust at high temperatures. The market expectation was that GaN and CIC would have their own separate swim lanes. Navitas would own the low to mid-power lane, and other companies would own the high-power CIC lane. The Navitas 2.0 reality throws that expectation out the window. By acquiring CIC-focused companies, Navitas is now saying it wants both lanes. Their new strategy is to be a one-stop shop for next-gen power, offering customers GaN or CIC, whichever fits the design best. On paper, this is brilliant. It expands their total addressable market immensely. It makes them a more comprehensive partner for a big automotive or data center client. But in practice, it's incredibly difficult. They are now competing with established CIC giants while still trying to convince the world to adopt GaN. It's like a software company deciding to build a competing operating system while also trying to sell its main app. It's a massive execution risk. This is the kind of complex corporate strategy that Fidelity brokerage research reports are made for, and it's a long way from the simple buy this pitch you might see for SoFi stocks. So, what is the future outlook? This is where it gets really interesting, and it all comes back to expectation versus reality. The base expectation is that the stock will slowly recover as the consumer electronics market rebounds. This, in my opinion, is the wrong way to look at it. That ship has sailed. The real future hinges on two completely different scenarios. Scenario 1, the bull case. The Navitas 2.0 pivot works. The $100 million in capital is the bridge they need to secure major design wins in the data center and EV sectors. The AI narrative is real, and the demand for power-efficient solutions for NVIDIA stock-powered AI factories becomes a tidal wave. In this reality, Navitas's GaN and CIC portfolio becomes the picks and shovels for the AI boom. Their revenue mix shifts dramatically from $5 chargers to $500 components for servers and EVs. The stock price, in this case, is not just undervalued, it's explosively so. The current $7.97 price will look like a historical footnote, the way early Apple stock prices today. Investors using Fidelity Investments or Interactive Brokers who understood this deep technical shift will be handsomely rewarded. Scenario 2. The bear case. The pivot fails. The reality is that they're too late. The CIC market is already dominated by giants, and their new tech can't displace the incumbents. At the same time, the data center market proves too slow to adopt their GaN solutions, sticking with proven, if inefficient, silicon. In this reality, the $100 million raise wasn't strategic. It was desperate. They burned through that cash trying to compete on two fronts and win on neither. The dilution becomes the story, the losses mount, and the stock bleeds out. This is the risk that has many traditional Fidelity wealth management advisors staying on the sidelines. It's the harsh reality of investing in high tech, and it's why an intelligent portfolio or a diversified Fidelity ETF strategy is often recommended over putting all your chips on one speculative name. Here's a question for everyone